The number one factor that could skyrocket your mortgage renewal costs. If you have a variable rate mortgage, you are rightly concerned about the Bank of Canada's interest rate that was recently left unchanged at 5.0%. The prime rate and your variable rate are directly tied to this bank rate. However, if you have a 5-year fixed mortgage and will be renewing soon, the Bank of Canada's interest rate is only marginally responsible for the huge increase you'll have to absorb for your renewal mortgage rate and increased monthly payments. In this video we will examine the main source for the increases in fixed-rate mortgages and where these rates may go in the future. Before we start, please click the like button and subscribe. We'll be discussing these and similar issues in the future on this channel, and we welcome your comments and input. Mortgage rates, more specifically 5-year fixed mortgage rates, are directly tied to the bond yields, which have been skyrocketing in both Canada and the United States. Canadian mortgage holders should indeed be concerned about both bond yields and the Bank of Canada's policy rate. But the impact of these two factors on mortgages is different. Let's examine the distinctions. Bond yields. Mortgage rates are influenced by long-term bond yields, particularly the yield on Government of Canada bonds with a similar maturity period. For example, 5-year fixed-rate mortgages are often linked to 5-year government bonds. When bond yields rise, the interest rates on new fixed-rate mortgages tend to follow suit. This means that if you're looking to renew or get a new fixed-rate mortgage, higher bond yields can lead to higher mortgage interest rates. Variable rate mortgages are also affected by short-term interest rates, which are influenced by central bank policy rates. However, they are also sensitive to longer-term yields, as banks factor in expected future interest rates when setting variable mortgage rates. Bank of Canada rate. The Bank of Canada sets the target for the overnight rate, which affects short-term interest rates in the Canadian financial system. This, in turn, impacts variable rate mortgages. When the Bank of Canada increases its policy rate, the overnight rate, variable mortgage rates may rise, making it more expensive for those with variable rate mortgages. However, changes in the overnight rate generally have a more immediate and direct impact on variable rate mortgages and other short-term loans. So, why might mortgage holders be more concerned about bond yields than the Bank of Canada rate? Long-term versus short-term impact. Bond yields have a more direct impact on fixed-rate mortgages, which make up a significant portion of the Canadian mortgage market. An increase in bond yields can lead to higher long-term fixed mortgage rates, affecting both existing mortgage holders with fixed-rate loans and potential homebuyers. Variable rates versus fixed rates. Canada's mortgage market includes both variable and fixed-rate mortgages. When the Bank of Canada changes its policy rate, variable rate mortgage holders feel the impact relatively quickly. However, the central bank doesn't directly control long-term bond yields, so changes in those rates may not be as synchronized with Bank of Canada rate changes. Market dynamics. Bond yields are influenced by a variety of factors, including global economic conditions, inflation expectations, and international market forces. These can sometimes lead to bond yield movements that aren't directly tied to the Bank of Canada's policy rate changes. In summary, Canadian mortgage holders should monitor both bond yields and the Bank of Canada rate, as both can influence mortgage rates. But the specific impact depends on the type of mortgage they hold. Fixed-rate mortgage holders should be more concerned about bond yields, while variable-rate mortgage holders should pay closer attention to the central bank's policy rate changes. Additionally, economic conditions and market dynamics can introduce complexities into how these rates move. Canadian yields won't stop ripping higher and mortgages are following. Canadian bond yields are experiencing a significant surge, with the 5-year government bond yield reaching a level not seen since 2007. According to an article by Daniel Wong in Better Dwelling on October 3, 2023, this surge is driving up mortgage costs, especially for 5-year fixed-rate mortgages, as these are closely tied to government bond yields. This situation is raising concerns among borrowers, as central banks are indicating that higher interest rates are here to stay. The rapid increase in bond yields has been particularly noteworthy over the past year, with a substantial portion of this increase occurring in just the last 5 days. This sharp rise is significant not only because it has pushed yields to 52-week highs but also because it represents a level of sustained yield that has not been seen for around 20 years. While comparisons are made to the 2007 level, it's essential to note that back then, bond rates at this level were only brief, lasting for fewer than 3 months. In contrast, the current scenario suggests that these higher rates might persist for a more extended period, impacting borrowers more significantly. The impact of rising bond yields extends to various mortgage types, including fixed and variable rates. Notably, the gap between 1-year and 5-year bond yields is narrowing, making it more expensive for borrowers looking for fixed-rate mortgages. Variable-rate mortgages are also feeling the pressure, especially as the overnight rate is now at 5%. This shift in interest rates is a result of several factors: inflation, global economic shifts, and the increasing competition for investments are contributing to the rising yields. The article concludes by suggesting that Canadians should prepare for the possibility of higher interest rates being the new norm for an extended period. While some had earlier anticipated rate cuts, the persistence of inflation suggests that even if rate cuts do occur, they won't be as cheap as pre-2020. The changing dynamics of capital allocation and international investment are significantly impacting Canada's bond yields and, consequently, mortgage rates, prompting borrowers to brace for higher rates in the foreseeable future. Surging bond yields add to Canadian homeowners' mortgage pain as renewals loom. Canadian homeowners awaiting mortgage renewals are facing the prospect of a significant interest rate increase due to a surprising surge in global bond yields. This surge in bond yields is set to tighten household budgets further in an already challenging economic environment, reports Nivedita Balu of Reuters News in an article on October 7, 2023. In Canada, homeowners typically take out 5-year mortgages, which means those who secured sub-2% fixed-rate mortgages 5 years ago are now bracing for renewal letters with substantially higher interest rates. Some renewed home loan rates could reach as high as 7%. Leading to increased monthly mortgage payments. With around $200 billion in home loans set to come up for renewal in the near future, mortgage brokers and lawyers are preparing for more distressed property sales. Homeowners have been reaching out to mortgage experts for advice on how to navigate their upcoming mortgage renewals. The surge in bond yields, which has seen the Canadian 5-year yield rise in recent months, is expected to be reflected in renewal rates. This development follows variable rate mortgages, which had been increasing in tandem with the Bank of Canada's rate hikes. As the country's mortgage debt reached $2.1 trillion, the rising mortgage rates are likely to further strain household budgets, exacerbating the cost of living crisis, and impacting Prime Minister Justin Trudeau's popularity in opinion polls. The article reports that 1 in 5 borrowers expects to renew their mortgage in the next year, with this number expected to rise over the next 3 years. The spike in bond yields is predicted to increase monthly payments, making it a cause for concern among homeowners. One potential solution for homeowners is re-amortization, which involves extending the number of years to repay their loan. However, there is a consistent and widespread worry among homeowners about these developments. What do you think? Will Canadians be able to weather the mortgage rate storm? Or will we see a United States-style housing market crash similar to the American 2007 and 2008 financial crisis? Please join in on the conversation by leaving a comment. If you found this video and information useful, please smash the subscribe button and hit the notification bell so we can keep providing you with timely information you can apply on a daily basis.